In private markets, liquidity has always been a challenge, but that is changing with the rise of secondaries. To unpack the growth and impact of this evolving market, I'm delighted to invite Krishna Saraswati to lead our next session, Emergence of Secondaries. Krishna is the founder of Private Circle, a research plus connect marketplace platform that brings together growth companies. Uh, Please join me in welcoming Krishna.
All right, please, can we all welcome Zerin, Nitesh and Alok. I'll give a brief introduction to each and then each can talk. Zerin runs an investment bank called Indigo Edge for the past 20 years, has done more than 200 transactions, running about $3 billion. And more recently, Indigo Edge has founded Pixel Sky, which is a direct secondaries fund. With respect to the topic that we have, which is emergence of secondaries, I think it's a very important movement that we should be thinking about. Alok, who's with us, is also a veteran in the space. Used to head HSBC's investment arm in India many years ago, and in the most recent avatar is running Foundation Private Equity, which is a Pan-Asian secondaries fund. Does a lot of GP-led restructurings, continuation funds, so on and so forth, which is again a very recent phenomenon in the Indian space, and therefore a very relevant voice to know from. And of course, Nitesh is the Chief Investment Officer of single family offices, the Baldota family office now. But again, he comes with almost 2 decades of hedge fund experience, VC experience with NEA. And in his most recent avatar, he has probably invested north of $45-50 million across many funds. And of course, direct investment in more than 20-30 companies now. So, welcome.
Thank you, sir.
Thank you. The topic today essentially is the emergence of secondaries. Now, just so you guys know, I've also been an investment banker in the mid-market space, largely in the primary space. And I think up until a few years back, maybe 5 to 7 years back, India was known as a market to invest, but there was no exits happening in the Indian space. Post that, the IPO markets have become a good channel for many GPs to think about exits. And recently, we are also seeing some strategic exits also happening. But this trend of secondaries funds, whether it's direct secondaries funds or helping GP-led restructurings, is something that I think all of us would learn a lot about, right? So from that point of view, allow me to, why don't you start with yourself and talk about your journey from where you started as an investment bank to today, and why secondaries is what you're thinking is the place to be, or a very active space today. Just to give some context over the last few years, and then perhaps we can then go into the details of secondaries. Zerin, can we start with you?
Thanks, Krishna. Am I audible?
Okay, great.
So Indigo Edge was started in 2006 from business school. We really did not have any investment banking experience. I was just remarking 5 minutes back that I didn't know what a term sheet meant in 2006. Those were the early days when Flipkart was raising angel capital. Swiggy was a company where Indigo Edge raised the first 2 institutional rounds. So it was like Vegas, it was a desert. Today the market is so deep, and the number of AIFs or new funds coming into the market is growing at such a huge clip. So I keep telling people that in 2015, the kind of market it was in terms of the number of founders and the number of funds, we are at a stage where we are going to have a lot of new funds and a lot of new LPs or family offices.
Yeah, absolutely.
So that's the second cycle of the market that's evolving. So it's like a derivative to the primary market.
Mm-hmm.
So having spent 18 years between 2006 to 24, there's a unique set of trends coming together in the market. Our public markets are structurally very sound, well regulated, democracy, the third largest market cap, last when I checked. And almost everyone joining the workforce can invest in public markets a lot more easily in this country. Everyone makes it so easy that you can click a button and buy any share or get into small case. So everyone coming into the workforce will invest. Gift City is enabling foreign capital to come into the public markets. And thus, the supply of capital in our public markets is going to be great.
Oh.
The other great thing is the cost of listing a company is not huge in India. A company with a 500 to 1,000 to 2,000 crore market cap can list in India, but it's very tough for such a company to list in the US markets.
Oh.
So these two trends and late stage funding drying up meant a lot of the tech companies started getting profitable.
True.
Along with that, the people who spearheaded this revolution in 2014-12, who said, I will provide exits by 2024, are a little short in terms of estimation. I think these exits are coming in 26, 27 and so on. And they can't wait any longer. So great companies, people who said things will happen in 10 years, it's happening in 12 years, 15 years. So all these trends coming together has meant there needs to be a set of investors like Alok, ourselves, who are able to buy positions from people who need to exit due to regulatory reasons or tactical reasons in great companies which will get liquid in the next 3 to 5 years.
Yep.
So that's the trend we have got.
Yep, that's great. I mean, Alok.
Yeah, thanks. Hi everyone. Thank you to the CFA Society for inviting me. Very happy to be here. Just to add to what Zerin said, one fundamental nature of our markets is that these are really closed-ended markets. In absolute majority, private equity VC funds the world over are closed-ended. Hence, they typically would need a liquidity solution or something like that for a lot of the geographies and vintages and certain strategies. Now, what has happened is in the developed markets of the US and Europe, and these are 3-4 decades old, they have seen multiple fund cycles and the like, and hence secondaries has evolved naturally as an asset class which sits alongside the private equity markets. And it kind of, one hand, shakes the other. They have become liquidity providers of sort to the industry as a whole. As a corollary in Asia to some extent and a limited extent in India, this market is now starting to evolve. The Indian PE/VC markets are about 2.5 decades old. Really the main momentum in the markets has come over the last 13-14 years with the EIF regime starting in 2011-12. And now that is also starting to see fund cycles. So Zerin mentioned about the regulatory aspect, and we'll touch upon that a little later. There are fairly stringent regulations now laid down by the regulator last year about end-of-life situations. And we feel that, along with the requirement for liquidity, has resulted in creating secondaries as an asset class. For us as a firm, we are investing currently out of a US dollar fund. We are a Pan-Asian secondaries fund. We don't do direct secondaries. We do what is called as LP-leds and GP-leds, and touch upon that in some time. Essentially, what we do is we provide liquidity solutions to investors and or fund managers for existing funds. Now, that could be in the form of a continuation fund, a portfolio carve-out, a spin-out, all various things. And we think that is starting to become a very, very interesting market in India. And as coupled with the regulations as well as with the general liquidity pressures, we think that could be a very interesting play, particularly for the EIF ecosystem as a whole.
Well, so just to summarize, it's basically there are good companies out there. There are fund life situations out there which necessitated the existence of these funds to provide liquidity to either GPs or LPs. Now, I want to probably introduce you now, given your vantage point as a family office and having invested in a variety of funds. I'm assuming a lot of them are the direct VCP funds. Yeah. How are you looking at either investment in funds or probably investing in secondaries funds, or and how does your allocation move now between what was just directly into companies and funds, and now you have a secondaries also coming in as an emerging asset, emerging investment. How are families thinking?
Sure. So, I mean, I'm not talking about the overall family offices ecosystem in India. I would, kind of touch upon our strategy.
Sure.
So, we started investing somewhere in 2017. That's when the trust was formed. So, it's been a good sort of an 8-year journey. We have currently invested in around 43 odd funds across India and US, right? So, it was more like the family wanted to, kind of invest in the index, right? So for unlisted, so he said there is none, so let's create one, right? So that's why it was small, 4 crore sort of checks, right? Average is what we have currently deployed across these funds. So total committed capital is around 20 odd mil. Total called capital, because I mean they called over a period of time, is around 14 mil. Now come the slightly shocking numbers, right? And therefore I'll come to that. So the DPI is what gets distributed, is only 9.8% for us right now, right? And the IRR is around 11%. That's basis the current to NAV, which the funds are, kind of talking about, right? And these are all the funds. Of course, the range is 0.5x to around 6x, right? The TVPI. So that's the range across all these funds.
Huge.
So between funds which have really not done well and funds which have really done well. So it's a broad range, right? So I mean, we now need to look back and say, okay, how would we identify the ones which are at 0.5 and look closer to the 6-ish or so, right? So there's one at 6 and then there's several at 3-ish. That's where all of them are. Now I'm double clicking further. Of the 14 mil which has been called, it's been roughly 7-7, right? So the 7 is in the US and 7 in India. And interestingly, the DPI and IRRs for both US is lower than India.
Wow.
Right, so the US for us is around 8% IRR and India is around 14%, right? While the Indian funds we have invested more recently. So US has, I mean, we talk about US and there have been secondaries. There are strategic exits because there are this whole buyer ecosystem.
M&A.
Google will go and buy multiple companies and so on and so forth, right? But TCS and Infosys don't, right? It's not in the DNA of Indian companies to buy somebody else, right? It's a right?
Correct.
That's the kind of general perception, right? So how do you exit? In India is therefore a sort of double whammy. There are no buyers out there if you can sell the company, because the buyer always thinks that he can recreate and create, build versus buy, okay, I'll build it. Nor can you sell it to somebody else, because it's like, मैं कोई stock बता रहा हूँ ये खरीद ले, and then at the same time I'm selling, right? अच्छा तू बोल रहा है कि खरीद लिया और तू तो बेच रहा है, right?
Right.
So whenever let's say a series A company would go to a series A fund would go to a series B fund, saying, yes, please buy this out. But I'm exiting, right? Achha, you are saying it's good, then why
are you exiting?
So
Sure.
then I mean they'll go on stretching the time, right? So therefore DPS has been really low across this ecosystem, and that's been a problem both across US and India for all institution capital, right? There are a lot of very prominent institutions which are pretty much, kind of writing off the PVC sort of thing, right? Saying this is all hoax, money is not coming back, and so on, right? So there's a lot of pushback happening. Therefore, the whole secondaries which is coming, I think it's a great timeline. This is the first time a regulator has come in between a fund manager and their
investors,
the GP and the LP, and trying to kind of it's not what you guys say, right? I'm imposing a commercial diktat between the two of you, right? So it's great that they are doing it, because I think it is required. Maybe other regulators across the world will follow suit. Touching upon how I'm trying to then reallocate, right? So directs for us have done well. I mean, maybe we've just been lucky. So we've done around 33 odd companies, and that's tracking at around 40 odd % IRR right now.
Wow.
So now the family say, okay, let's just pause a little bit of the funds and try to do more directs, right? So that's the broad sort of a direction in which we're going. However, given the regulatory thing which you will touch upon, I think it's a great time for secondaries fund to be out there. It's a great entry pricing advantage to get, because it's so regulatory arbitrage, and therefore we would look at either doing what you are doing in some form ourselves, where we'll go to a couple of our fund managers and say, okay, do you have any kind of position which is ripe for 2-3 years into an IPO, and then let's try to take a bite of that.
Correct.
Or participate through for financial services.
Thank you. That's very interesting.
So,
if I could just ask Tish a question.
Yes, please.
So, I mean, it's fascinating, the data. The DPI in India seems to be better than US, but you also touched upon how the exit ecosystem is a lot more mature in US vis-a-vis.
That's it.
So do you have any theory of why that is the case?
So I think, again, when I'm then looking at vintages, right, 2017, 18, 19, 20,
Just
very interesting is also that 2017 and 2022 is the one which is given the bit most. Right, so 17, of course, because it's the, it's most mature. And 2022, because it was immediately after 2021 when craziness was happening, 2022 when,
Yes.
shit in the fly, the
Markets
the
really
fly,
crashed.
and then everybody is, kind of very profit focused and all of that, right? And I think that was more pronounced with India than the US. I mean, that's my theory, right? Because in India, all the founders started talking about profitability. That's why they're all going towards an IPO. Initially, I mean, there are conversations where there have been, where the founder is pitching and the investors ask you, okay, what's your whatever profit or something like that, right? The major case is he asks the founder says, I don't think you're the right investor for us, right? Because you're talking about profitability. Now, if any founder is pitching, within the third sentence, he's talking about, I'm going to break even by this.
Yeah.
I'm going to break even by October, I'm going to break even by December, right? So clearly the focus has shifted so much towards profit.
And do you think it's also to do with how strict our regulators about fund life vis-a-vis Cayman funds or?
Absolutely. I think that would also have
That's been
definitely played
going to be a key
part.
trigger.
For the same equity which two fund managers held, one in Cayman, one in India, their attitudes are very, very different with respect to do I need to sell it.
Correct. The Indian, I mean, all the fund managers out there, right? They have a dedicated exit team. All they're doing is exit. They're not, I mean, their monthly, weekly review is more for, I mean, I know a couple of fund managers, very prominent, $1 billion plus on the AM. They have a weekly meeting for exit, concept of exit. Right?
I have come across funds domiciled in offshore Mauritius, etc., which are 2006 to 2008 vintage, very much around. The investors must be seriously frustrated, right? What's going on?
So, I mean, all of this is just leading to very interesting developments in terms of what, if I could use the word of interstitial type of funds that can provide exits or actually get in with discounted prices and actually make money when they're exiting themselves. This is something that is just a recent phenomenon, right? But for the benefit of the audience, I just wanted to go back maybe a couple of cycles and put this in the context of, again, the IPO cycle that was there, and then there's a strategic exit cycle that really did not materialize as much as it should have, given what Nitesh also just mentioned. Ki Indians with strategic exit to zyada hai nahi. And then how does this now position itself, these new structures, how does this position itself? Does that mean that, let's say the IPO cycle is going to get extended a little bit, or does it mean that strategics are going to come in because of this new thing? Or is it just that, and of course from a GP point of view, I suspect a lot of them should breathe some sense of relief, right? That for situations where there are no exits, there could be portfolio carve-outs, there could be structures such as this that gives them that avenue to exit, right? So from these 3 point of view, can we start from the IPO or from a GP mentality point of view, like how you see the GP mentality today and their experience, and what is it that these structures will mean in the next 2-3 years from now?
Sure. Yeah, so you're right with respect to IPO cycles. Speaking to a few GPs, so we'll use the term GP and fund manager.
Yes, I think. Yeah, exactly.
As for general partner in the fund. So the GPs have been saying that if you miss the June cycle of going public, then you're not going to go public in this cycle, because the markets, whoever gets out of the gates before June, the filing is done, they will probably list. There's a lot of uncertainty around pricing. So fundamentally, sound companies are willing to wait, the founders and people who are playing long. The funds who can't wait are looking for solutions. As an investment bank, we have cleaned up a lot of cap tables. And when we say cleaned up cap tables, it means when the company goes public, the investors need to be patient, not sell at the 6-month period. They need to have runway of 5 to 6 years. So I jokingly tell my co-founder it's called patient capital as a service. So you extend the runway of the cap table in fundamentally sound companies that will list, compound and stay. So direct secondaries are happening between institutions. A Goldman will sell to an Adia or things like that. Those large blocks are happening. Then like Foundation Capital, Alok would be one of the ports of call for people who need structuring solutions and cannot wait. So they may give a portfolio or, I mean, I think he'll touch upon that. See, with respect to strategics, I don't see anything changing. India still remains a very nascent M&A market. However, one interesting new trend that's going to come is in these 30-40 tech companies that have listed, the Zomatos, the Swiggies, all are going to get acquisitive. Their corporate teams are going to start providing exits to the middling companies. So that trend of exits will also start happening.
Interesting. So fair to summarize that if IPO cycles are cyclical, once every year, strategic exits are just still nascent but growing, then a lot of the liquidity solutions for the GPs, etc., will have to come from this restructuring and all of this.
Yep.
How do you see the demand for that, and how are you, and how easy is it to actually negotiate a transaction in these cases? Because it's going to be quite complicated, as I can imagine. A single investment into a company is complicated as it is.
Alok, all three of us are looking at you.
Yeah,
Sure. Can go for that, yeah. No, I think Zerin raised a couple of valid points. 2-3 observations. One is, all else being equal, a GP would like to hold on to their portfolio. Like if they get that additional 2, 3, 4 years, which is always the case, you always need that extra little bit of time, they will do within the limits of fiduciary responsibility what they can to hold on to the portfolio, which is why a continuation vehicle or a continuation vehicle type product is very, very attractive for them. So in a continuation vehicle, the incumbent GP is managing the portfolio on behalf of typically a new set of LPs. Some of the LPs may roll over, some of them may exit because they have time constraints, etc. So pricing being what it is, you'll have a new set of LPs and the same GP. Now the GP in there is a total state of conflict because he's literally flipping sides, but that's a nuance we can talk about if we have time. So coming to the point, what has happened is with the regulator has not really basically given the industry much of a choice. There is some choice, no doubt, but not much of a choice. Therefore, there is a great demand now to start figuring out liquidity solutions well before end of fund life. In my opinion, personal opinion, that's been the key single trigger. So 2-3 years before end of fund life, with the extensions and everything else, GPs are now saying, okay, guys, what can we do? Can we start selling? Can we start marking down a portfolio to bring the gap between DPI and TVPI down to saner levels, which has been a big problem always, as Hitesh mentioned. So those are some of the, I would say, the positive things happening. How many transactions fructify? How do they fructify? What kind of form they take is obviously up and running. So if you want to set up a continuation vehicle, you will have to, and it's set up as an AIF, you will have to subscribe to the SEBI norms of the concentration limits. So you'll have to have typically more than 4 or 5 companies, etc. All those typical AIF categorization. So for the larger funds which have a huge portfolio, they are starting to thinking about spinning out CVs, right? A lot of larger funds also have another problem. They are just too many companies. So they want to just exit them. They don't want to continue managing them, right? They want to prioritize. But then if you sell all your not so good companies, who's going to buy them, right? So it then becomes a mix and match of what you can do. But coming to the point, I think the general demand, just because of lack of liquidity options as well as regulatory pressures, I think there is now a very, very clear acceptance, if I can say that, okay, secondaries are something which can sometimes provide, not always, but sometimes provide a solution.
And just a question in my head now. While you're doing this portfolio carve-outs or, the GPs are generally wanting to continue on assets that can have more potential going forward. Does this also imply that the kind of companies that you're looking for, that the underlying companies in all of these are essentially maybe 3 to 5 years to IPO?
Typically, yes.
Or can there be GP continuation structure for very early stage funds?
Great point. I'll just take that. I'll have one small quick comment on that before. So what happens is when we underwrite a transaction, when we underwrite a fund restructuring, for example, we typically look at an underlying exit of 3 to 5 years, right? Which is the entire product appeal of a secondaries fund. So we typically look at a relatively lower MOIC but a high IRR because of the fact that we try and exit our portfolio in the next 3 to 5 years. And the whole idea is that there's been a lot of heavy lifting already done for 7, 8, 10 years. Why do you need that much more time, right? If the portfolio needs another 7, 8 years, we won't do the deal. It doesn't make sense for us, right? So what happens therefore, and that answers your question, that we typically don't like very early stage companies or funds, right? Because what are you going to do with them, right? We see very, very attractive deep tech funds, outstanding, get really excited about them, but we won't do those deals. Yeah.
But I mean, I'll add a perspective more from the GP lens, right?
Yeah, please.
Your lens, right? So a typical GP would have, let's say, I'm just making up a number, right? 20 companies in the portfolio, right? I mean, that would be, let's say, a typical number. There are very early stage, the YC types, which have 200 as well. The more late stage one would have 10 companies as well, right? In a portfolio. So let's say there are 20. Now, typically the 10-year life, right? So for 10 years from first close, and SEBI saying कि 10वें साल में आपको पूरा बेचना है.
Right.
Now, out of the 20, let's say I'm just again making up a number, right? 5 have died. Clearly 2, 3 have the potential of going to an IPO, right? Maybe 3, 4 at best.
Sure.
So irrespective of what the cycle, they can only look at these 2, 3, right? They can't look at the rest of the companies from an IPO perspective at all. Then there are these
Building.
I won't even call it building companies. I would still say, okay, 3 years to an IPO, they have a potential, but just not now. Like they can't get off the king right now, but they're there. So that's where they can go to, let's say, funds like you were saying, okay, it's 5 years to life, and then try to take it out, right? So the GP is trying to figure out anything, right? There's very small companies is trying to kind of swap it to one of the other portfolio companies, right? The ones which are really at the laggard, he's just saying, okay, let me just get rid of it because it's anyway not going to give me any value, and he's just trying to kind of clean up the entire 20, right? So protocol is let me just do a share swap and let me get the shares of something else.
Correct.
Right, which is slightly kind of more mature, right? And get rid of the bottom layer. The really middling ones is what he's trying to go to his LP base and saying, okay, saaf khareed lo, right? We get calls all the time, right? I'm trying to sell this at deep discount, and I'll give you some numbers. I'll not tell the name. The last valuation was at 13,000 crore, available at 7,500 crore, right? So those sort of discounts is what we would typically kind of hear. There are if it's a venture debt fund which has got a warrant position, they would give a 70% discount, right? They would sell at 30 cents to dollars, so to speak, right? So significant discount, then ki aap khareed lo, right? And take this off because it's middling. The secondaries fund which have 4 or 5 years sort of the view are not going to buy it, and they have to clean this out, right? So they are looking at that. Then this 3 to 5 year to an IPO is what fits in best to essentially go to secondaries fund, either GP led or non-GP, right? And so there are both GP led solutions here. There are let's say funds like 361, right, which are going to the GP and saying, okay, you sell this to me, and going forward I'll manage it. Where foundation capital would do it is where they will say, okay, you only continue to manage it, and I'll give you fees for that, right? So those are the two sort of solutions that are trying both there. So pretty much, they're trying to do everything under the sun to get rid of all the.
I think that's a great observation. Yeah, they're doing everything under the sun. And ideally, as you said, when you take a large portfolio, you see if I can sell something right now at acceptable price, liquidate, right? Hold on, mark down, whatever. Right? I think that's really been the key takeaway for me, that over the last 1.5 years, with these regulations in play, now fund managers are really, really putting effort to figure out where the liquidity can come in.
See, the other aspect of this is the fund manager raising their next fund.
Exactly.
So for tactical reasons, showing DPIs, being in the news that we made an exit,
Absolutely.
might financially be not the right decision, but for the next fundraise, it makes sense. So these decisions there's a lot more to it than what meets the eye.
We did one transaction where very similar structure, requirement rather, wanted to improve DPI, raise the next fund. We carved out 3 assets into a gift city vehicle, and the GP continues to manage it. So I think there's a lot of liquidity and flexibility around structures which can work.
So 2 things. One is probably this is a good time for us to get into understanding what the regulations are with respect to secondaries funds. But before we get into that, while I do understand that the focus of the secondaries funds is 3 to 5 years IPO, is there a global construct or globally are there constructs for providing secondaries exits to the early stage funds, right? Because historically, if you look at India, the Series A, B, C, the Series A, B, C funds are not necessarily, in some cases they do some secondaries, but they're not necessarily there to provide secondary exits to the previous GPs. And if you're looking at 3 to 5 year IPO, then you're necessarily looking at Series C plus companies, which will fit your bill.
Yeah.
So what happens to globally? Are there secondaries funds for the Series A, B? And is there a possibility that in the next 5 to 7 years, we could find those kind of structures coming into India?
So I'll just give a perspective in my end. So when we are trying to figure what to do in the secondaries market, that's when you hear the word CV, continuity vehicle, for the first time. When you dig deeper and deeper, it seems to be a very large global phenomena.
Yeah.
But if you peel the layers, most of the CV, the continuity vehicle capital over there is for buyout funds
Single assets.
who have missed the timelines of listing a company they bought out and hope to turn around or improve and list.
Great point.
So typically, you miss your timelines. That's the arbitrage where a continuity vehicle comes in. And for an early stage fund, when they're raising capital itself, it's 10 plus 2, 12 years. So it's unlikely to have CVs for early stage
I agree.
funds.
I agree.
That's my take on the matter.
I agree. I think there's 2 points I'll add very quickly. There are secondary providers in markets like the Silicon Valley, but I don't think it's a very deep market yet, even for the Valley. But my knowledge is limited on that. 2 is what Zerin said is very relevant. The secondaries market in the US, for example, there is something called a single asset continuation vehicle, where you take a single asset, and the interesting part is that your star asset is given an extension of life. In India, you're trying to sell not so good assets, right? That's the mentality. So
Plus, I mean, see, in the US, there was a very large private equity ecosystem. Right?
Yes.
So in India, it's essentially kind of skip that and went directly to the VC ecosystem. By that, what I mean is, in the US, a founder of a typical company out there would also own 5-10%, right? So the company would change hands like 5-6 times before it gets listing, with various private equity operators, in different stages of the company, right? In India, you think of family-run businesses, large family-run businesses, and now you have this whole kind of VC ecosystem has kind of come about, where the founders were diluted down to 5-10%, and then to some extent kind of therefore they're board managed, and therefore there are timeline pressures which will apply to this, right? In the near future, would there be such a vehicle like Zerin mentioned, right? It's already 10-12 years has already been given, and if it's not if not 3 years, if not 5 years, if not 7 years, it's not got to that space. It's typically a company which is not even middling, right? It's not going to go anywhere. Therefore, to find a buyer who will aggregate all of this and take it up, it's going to be fairly difficult.
So the power law rule still stays for those funds. There is not much of a problem for exit.
Yeah.
Now, we've got a question from the audience here for Alok. Typically, we've seen that LP rollover and CVs have been lower in Asia. How does an incoming fund like yours view the conflicts of interest that surround a continuation vehicle?
Great question. So there is inherent in a continuation vehicle, there is an inherent conflict with the GP has. He is, they are essentially responsible to the existing set of LPs, and then they will also be responsible to the new set of LPs once the transaction gets done. So when we do a continuation vehicle, and I think it's good practice for most people who work in this sector, is we typically recommend an advisor be appointed, an advisor who will step in and essentially be the bridge between the existing set of LPs and funds like us, who are putting a cohort of investors, including us and our LPs together. And what happens with these continuation vehicle deals is that they become very complex because you have multiple sets of people around the table. You have the existing LPs, you have us, you have the GP, and you have sometimes the portfolio companies which are impacted. Because if you're putting in primary capital into the portfolio, then we will do our diligence on the portfolio as well. So they need to be brought into the layer. Right. So these transactions take anywhere from 6 months to a year. Very, I would say, relatively complex. A lot of negotiations and everything else, which is why we always recommend that the GP, the incumbent GP, because what happens is, let's say your NAV is 100 rupees, you're bringing that down to, let's say, 80. The existing GP is getting his carry reset at a base of 80 rupees. So he's very happy, right? But the person who's taking the hit is the existing set of LPs. Yeah. They're not very happy, right? So there's obviously a lot of power play which happens in this. So we recommend that an advisor be put in place who then manages, and then a reputed advisor who then brings in multiple bids as well. Because then you source bids in the market and then take it to the existing LP so that they can make a decision.
Look, in these situations, from your experience, since this market's new and everyone's figuring things out, what's the trend of LPs? Are they rolling over, or like what percentage of LPs are?
Can I add one thing to that? I mean, it's the emergence of domestic LPs.
Yes.
Historically, most of the funds that we've seen have always had global LPs,
Absolutely.
institutional LPs.
Great point. So,
But over the past 4-5 years, a lot of the GPs have raised domestic capital, which may not be
yes.
institutional global, but it could even be private wealth.
Great point. So, if you're dealing with a foreign institutional LP, they're very clear. Price, I've taken a decision, out or in, right? They're very clear. The moment you come to the domestic set of LPs, in our limited experience, again, there are two sets. One is the institutional, one is the family offices, and they behave very differently. Right? Now, what happens is if you go to, I'm just mixing things. Suppose I go to buy an LP position, because that's again a mode of liquidity for an investor, not a full fund restructuring, but just buying a single LP position. Going and having an individual conversation with an institutional agency, be it governmental or a bank or whatever, is impossible, right? Because the moment you start mentioning even a small discount, the guy's not interested. However, if the fund manager stands up and says that, look, this is the fund level solution, I'm mixing an LP and a fund level solution, but give just for that, the acceptance from the various LPs is much higher because they have put their faith in the GP, and he's saying, look, this is the situation now which is making sense for us, therefore we will take it. To answer your question in terms of the rollover, I think it depends on where they are. Okay, one fundamental aspect we have realized is that if capital has been paid back, the dynamic changes completely. It's human nature across the world that I've got my capital back, okay? Whatever else I get is okay, it's a positive for me, right? It's a mentality. So then the dynamic has changed. You're sitting on a 0.3, 0.4 DPI after 10 years, it's not going to be an easy conversation.
Yeah.
Best of that.
So another question here, how maybe Zerin, you could answer, and how difficult is it to fundraise for a secondary fund relative to other funds, and what aspects of the pitch to LPs change?
Very interesting questions.
So I think let me talk about the difficult parts. So I think the institutional support is much lower from an India standpoint. People are raising primary funds. They're adding value. They're putting money into companies, helping the economy in a way. Secondary funds are some sort of financial arbitrage.
Yes.
Thus, like institutions like SRI and SIDBI and all of that, the what you hear in the budget, the 10,000 crore fund of funds that goes to the primary funds.
Yeah.
But having said that, there was an announcement around some money going into secondaries because the institutions have put in so much money, including SIDBI and so on. They also need to refresh that.
Correct.
And that spills back into economic development.
Absolutely. Absolutely.
So probably today it's difficult. Maybe institutional support will come a little later. And thus the large secondary funds are typically non-Indian.
Yeah.
You talk about NewQuest and TR and all of that. They've gone to commercially savvy institutions globally, Southeast Asia, or have India pools. So they're sitting on smart money to take advantage of the situation in the Indian market. It's tough for a domestic secondaries fund to raise capital. But you also do have advantages in certain deals. If you are an Indian fund, due to regulatory norms post-listing, you have more leverage because they don't want a foreign cap table. In multi-brand retail or insurtech, there are some spaces where being an IOCC, which is Indian-owned, so you have an advantage.
Yeah.
So that's the tough part of it. The good part of it is everyone's been crying DPI, which we just heard from the lines from the health. In this fund, people can clearly see that the DPI cycles are not going to be as bad. You're going to get money back in year 5, year 4, year 6. So the product structure is what people are waiting for. So, but you're not going to get too much institutional support.
Yep.
And it's a new product.
On that note, if domestic investors are not too keen to invest in a secondaries fund or come in as LPs to secondaries funds and are probably going outside, how is the foreign LP looking at investing in a secondaries fund in India?
So I didn't say domestic investor not keen. The institutions.
Institutes.
Yeah, that
Like
like
governmental
yeah.
That's true.
So typically, if you're raising, let's say, a 800 crore fund, 100 200 crores quickly comes from the fund of funds, SIDBI, and so on. So you have momentum,
Sure.
and then others follow. But in a secondaries fund, that institutional backing is not there. Domestic investors are taking. I mean, the family offices we've been speaking to are very, very interested because they like the liquidity aspect. They like the stage of the company aspect. So the product is appealing, but the rate of fundraise is going to be different in the next 2 years. But once the ecosystem matures,
I agree.
things will be different.
So the returns will probably get more capital.
And with respect to global LPs, they'll take lead from what in your home market, what are people saying?
And the global LPs, just to add to that, again, it's a little different. But the global LPs, if you look at the large secondary funds, they're not LPs, but say the Lexingtons and Collars and these kind of players, large players, they won't do a small deal in India, right? And that deal typically gets indicated out. They'll be one of the participants, so they will look at the $100, $200 million plus deals, which are happening, no doubt, but they're, slightly rarer.
And in the global markets, there's a slightly different trend, which I'm saying. They like single assets.
Totally.
If there's a block of Swiggy, they would prefer doing that. If there's a block of infra market or renew buy. So there are single asset SPVs where global LPs are putting capital.
I mean, NSE and Chris Capital did a $700 million single asset vehicle right overseas. That just speaks
the
to it.
appetite in the global market is more towards defined assets rather than blind pools.
Interesting. So maybe now we can talk about the regulatory aspects and what is the regulator thinking about, or the rules that they have for the primary GPs, and what are the rules from a secondaries point of view, and how is it clear enough, not clear enough, is it easy to navigate, and maybe we could touch upon those aspects a bit before. Sure.
As we mentioned, our regulator is probably doing a very good job in the sense they're protecting the LPs and in a way that's triggering the depth in the market from secondary funds and all of that coming in. So it's actually a good thing. I mean, there's nothing much more complicated in a secondary transaction. Other than, I mean, there are issues around tax, which is a different set of regulators, like what's a fair market value, and there are a lot of tax implications depending on who you're buying from and who you are. So NR2, R2, the whole very complex web of what are the tax implications. But that's a different set of regulators. From a fund structuring standpoint, it's good. The only thing which probably will improve the ecosystem is today, there's a lot of interest in single assets. Like when Zepto raised capital through Motilal Oswal, I think about 200-300 billion into a single asset. The structures to aggregate money from a lot of people are not there properly. It's some sort of jugaad which has happened.
They've done the LPs and stuff like that, yeah.
How do you give single asset which can be sashayed out to the retail investor from a structure standpoint? That's something the regulator should quickly work on. It will give a lot of depth to the market. People prefer not investing in a blind pool. They like single assets.
Yeah.
But I would, Alok, on the regulations, I just wanted to ask you, you mentioned three companies were put into a continuity vehicle. Was there an Indian structure or global?
Give City. That's why Give City.
Okay. So
Otherwise, you can't have.
Otherwise, you can't have it. And when LPs roll over, they pay capital gains and then come back in?
It depends. If you're changing the structure, yes. If it's extending the same vehicle, then no. Right.
And is that different in global markets? Is there a way to roll over without paying capital gains?
So what happens again? We did one Mauritius structure deal for a fund, Indian fund. We just extended the life, so there was no change at all, right? We just entered into a contract with the manager. Okay.
But typically, it will be a new vehicle, not an extension.
In India.
Typically in the new vehicle, in which case they have to pay tax.
So in fact, I'll just spend a minute on this if we have the time. We have the time.
Yeah, probably about.
So what SEBI said last year in their what is called as a dissolution period framework, and there was some toing and froing what we understand because they've now allowed the same AIF to extend. You don't have to create a new vehicle which would have triggered tax, right? So basically what they've said is that if you've come to end of fund life, stipulated as per your PPM, what is stipulated in your PPM, you have an option to extend the fund, but that is subject to two conditions. One is 75% LP consent, and two is 25% of the NAV as a cash bid.
Sorry, what's it?
25% of the NAV as a cash bid. You need to put a cash price, which say somebody like us potentially can do, right, as an example. If you do not meet the second criteria, you can still continue, but you need to mark your portfolio down to 1 rupee.
So 1 rupee, yes.
Okay, and what SEBI's done is they've nominated 3 agencies, NSE, Prequin and CRISIL, as the benchmarking agencies. All the AIF give them quarterly data. So that, unfortunately, the track record, will then stay with you. So there is a fairly serious implication if you do not meet these criteria, if you want to extend. Otherwise, you can liquidate and wrap up. They'll give you a little bit of time to liquidate and wrap up. But then if your fund is not in a position to do so, then you're stuck. Or then you distribute in specie, which is not a good thing. So it has become a little difficult now for GPs to find solutions. That's where they are.
So would it be fair to say it's easier to structure it out of India, the country vehicle?
In what sense? Sorry.
Like if like extending an AIF, if you're putting a new structure in place,
Yes.
would you put that the CV in India itself, or favorable jurisdictions which give you more flexibility?
Ideally you might want to go offshore or something, but then it'll be very difficult to do that, right? If you have an existing AIF, if you have an existing set of assets in an AIF, really not much you can do. You'll have to kind of look at a continuity vehicle around that.
So in a way, for global funds, it's easier to do CVs than Indian AIFs.
In some way, yes, definitely. And the single asset vehicle, which you said, right? That's really been the game changer for a lot of even the Asian funds, right? Because they take the best asset and they give it more time.
So probably we are closer to the time. There is one more question here, which I'll all three of you to look, because I'm not sure about how to look at this. Could tokenization or blockchain impact the accessibility and efficiency of the secondaries market? May not be with respect to secondaries fund as such, but when it comes to, let's say, others, I have not seen much of tokenization or blockchain, but there's...
in theory, yes, but practically, we were years away from any practical implementation of that.
Yeah, so would it improve efficiency? Yes, if it's implemented in a way it's a liquid market. So I think directionally, they are trying to make AIFs listable.
Yes.
And bring as much liquidity to... it's strange that you put so much money into an asset and you can't even take a loan against it.
Yeah.
Yeah. So we are a few huge years away from this being a more mature asset class. When you're an asset class which takes 8 to 10 years to mature, there's so many problems to solve in between.
Yeah. So anyway, just to summarize, I think it's been a lot of learning for me as well, sitting at the side. But if I could just summarize it for everybody, one is while there is the concept of exits via IPO and strategics, but this entire secondaries fund, directs or GP-led continuation ones are, in theory, a better returning structure, simply because you have better assets with shorter period to liquidity.
Maybe I would say better priced assets.
And better priced assets as well.
Yeah.
But still, it is a terribly complex exercise, and maybe the depth will come with time.
Yes.
And maybe regulator also has some tasks to do to make it more accessible for all the investors. That's probably what I am taking for myself today. And I don't have any more questions from the audience, so I guess this is it. Any more questions? I have not seen it, but I guess we could wrap it up now.
Thank you. Thank you, Vishnu.
Thank you so much for your time.
Thank you.
Thank you so much to our fellow panelists for such an insightful session. We would now request Krishna to please present our panelists with a small token of gratitude.
Yep.